Sanjeev, hi, good to have you on the show. Congratulations for a healthy quarter by you in a tough environment. What's led BOB, you think, back to profits in the first quarter and low slippages as well as lower credit cost on a sequential basis?
So I think there are two major aspects which I think have helped us improve things. One is on the structural side, where we have had a very tight discipline, both in terms of managing our liability franchise and also on the asset side. So on the liability side, when you have abundant liquidity, it is very possible that you allow deposit growth to run too far ahead of loan growth, which creates pressure on margins. We have tried to be disciplined, make sure that our deposit growth is in line with our loan growth. And because we were choosy there, we have been able to make sure that most of the growth has come from our CASA deposits. So the CASA ratio moved up during the year from 39% to nearly 43% over the last 12 months. So that is one, you might say, abiding benefit for the bank, not only in terms of margins for this quarter, but also going ahead. Similarly, on the asset side, there's been a lot of liquidity sloshing around, pressure on margins. We have tried to be disciplined there also, make sure that you grow in...
While both the slippages as well as credit cost has been lower sequentially, what is the kind of slippage as well as credit cost that you expect and foresee going forward? Where do you see your gross net NPAs, your net NPAs settle at for the financial year close?
So we had guided even before the second wave that we would expect slippages to be below 2% and credit costs to be between 1.5 to 2% and veering toward the lower end of that scale. We believe that despite the second wave, we should be able to deliver on the guidance.
All right. Hi, Mr. Chadha. This is Mubina as well joining in. Your overall exposure to NCLT accounts is a little over 48,000 crore rupees and the PCR is 94.8%. So to what extent of this amount do you see resolution? What's the kind of overall recoveries and upgrades you expect for the whole bank and from these NCLT accounts as well?
So the NCLT accounts tend to be very highly provided, upwards of 90%. In terms of, you might say, anticipating in which quarter would a resolution happen is always very difficult. So while we do look forward to the resolutions of NCLT accounts, we are making sure that in terms of our recovery efforts and in terms of our recovery budgeting, we are looking beyond the NCLT accounts also. It's very tough to say what will come in which quarter, but I do believe that there are some accounts which probably will happen within this year and they will contribute significantly to the recoveries.
Okay. Mr. Chadha, I just wanted to know what's your exposure funded and non-funded to Vodafone Idea? How much have you provided for and what's the provision you expect to make?
Let's put it this way, that our exposure is relatively small. So it's not something which could significantly impact the improvement in the corporate credit cycle we have talked of.
Let's talk about return ratios and profits. From a two-year perspective, what is the kind of improvement that you can expect on those two fronts? And also, how do you see yourself competing with the modern day players, the tech companies that are coming in and making waves in the space?
So two-kind question again, which you might say have two segments in terms of answer. One is in terms of the improvement in the profitability. I think that is something which is likely to be sustained over the next 2 years. It's simply because, again, one, we have built strengths in terms of the business, both on the asset and liability side. On the liability side, in terms of a CASA ratio now pretty much which compares with the best in the business. On the asset side, in terms of engines like retail growth, which again have been better than market. So we are very positive in terms of the structural story. Also, as we discussed, the improvement in the corporate credit cycle is likely to sustain over the next 2 years. Despite the second wave, we have seen even in this quarter, the impact on corporates has been very, very marginal. Therefore, we can be fairly confident that the improvement that we have seen should continue going ahead. So I think these two factors, the structural improvements in the balance sheet of the bank, the earning power that has accrued to the bank from new businesses, and also the cyclical story, they should again help us have a sustainable improvement and get back to return ratios which are very respectable. Coming back to the second part in terms of the challenge of fintechs, I think fintechs, the fintech piece is something which is really an opportunity for banks, it's a great opportunity for us to collaborate with fintechs to create new businesses. So even as we speak, we have a very significant digital initiative which is being rolled out, where we are collaborating with a large number of fintechs. We expect that a large part of our loan underwriting, particularly on the retail side, should be digitized over the next 12 to 18 months. And all of this will happen in collaboration with fintechs, who would be our partners. So I don't really see competition with fintechs as a zero-sum game, which is at the cost of banks. I think it's a great opportunity for the banks to, in fact, become much more efficient.
Mr. Chadha, the bank's net interest margin has improved, at least for the domestic NIM, to 3.12% rather. And given that interest rates seem to have bottomed out, what is the outlook that you have for the rest of the year as far as global and domestic NIM is concerned?
So I think as we were discussing, the net interest margins ultimately are a sum of what is your liability franchise and what you do on the asset side. So on the liability side, the fact that we kept very tight discipline in terms of deposit growth, made sure that it came almost entirely from CASA growth, meant that there was a very sharp reduction in the cost of funds. So I think that has been a primary driver of the net interest margins. The second piece that has worked for us is, again, on the asset side. We have opportunities to grow in categories apart from corporate loans, where particularly for the highest rated corporates, the margins were under pressure. So if you see the growth of the bank's book, that has come more from the retail side, from gold loans rather than from the corporate side. So that is the second part that has helped us improve our margins. The third is we are looking very carefully at an international banking book, where margins tend to be lower than the domestic book. And we have tried to make sure that there's an equal amount of discipline there and also reshuffling of the portfolio to improve the margin on the international book. So I think these three things coming together have helped make an improvement in margins. To some extent, you might say they can be one-off factors, but I believe they are marginal. In our view, we should be looking at a 15 to 20 basis point improvement as far as NIMs are concerned for the entire year. And some of the strengths that you gather, for instance, again, the CASA ratio moving up, they are abiding benefits. And these will benefit the bank even going forward.
Sajeev, great to have you on the show. Thanks as always for taking the time out. In fact, on that note, we're going to wrap it up on this edition of The Market. It's a goodbye from Mubina, Alex and me. And we leave the market pretty okay, hovering around the 16,300 mark for now.